Hi, this is Chris Diodato, and this is my current Elliott wave analysis of the stock market. As of, today is September 15th, 2011. I'm going to start from the bottom of the, bottom of the cycle count 5, or what is more commonly known as the bottom of the bear market in March of 2008, and I'm going to go forward from that point. Okay, we're starting off. The bottom of 2008 was the beginning of a wave cycle one, a wave one cycle count, which that wave represents the business cycle. It might have also been the bottom of another wave because this bear market was very fierce. It might have also been the bottom of a super cycle, which is composing a larger business cycle, such as the 15 or the 52-year business cycle. Since they might have hit at the same time, that might have been the reason why this bear market was so tough. Okay, next we have our wave 1, and of course it's composed of 5 up waves. So we have, first wave right here, second wave, and this wave is composed of, this one has an extension. Oh wait, no, first wave, second wave corrects to the downside. Third wave has an extension, which makes it divide into 9 smaller waves, usually makes it a larger wave. 1, 2, 3, up, down. This is the fourth wave right here, and then the fifth wave up. And then at this point, we end wave 1, and we begin wave 2. Wave 2, 1 down, that would be A in the primary trend. Then we would have B counter trend, also a primary wave, not a cycle wave. This entire thing that I'm talking about, until I say we're in cycle 2, then we're going to stay in cycle 1. And then finally C, giving us our final downswing. Wave 2 has ended, starting at this point right here. Wave 3 starts. Wave 3 is also extended, composed of 9 subwaves. Wave 3 is usually the wave that is extended in an Elliott wave cycle. 1, up, 2, 3. 3 upswings where we have composed 9 subwaves. This is our third. The third one ends finally right here. Wave 4 corrects down. A, B, C, and then we keep moving on. Wave 5 is an impulse wave, which just means that it's basically a straight line up. So we have wave 5 up, finally breaks right here. This ends primary wave number 1, which means that we should have a primary correction. This was right before the flash crash last year. Wave A down, wave B up, counter trend. Wave C does the most damage, and wave C finally ends in, wave C, there we go, my bad. Wave C, this type of correction, which even though it moves up to, this is I think that the terminology is a irregular flat, as Richard Elliott would say, or an expanded flat. Wave C corrects down. Wave 1 starts right here. This is wave 1 of cycle wave number 3. So cycle wave number 3 starts here. Primary wave 1 is a leading diagonal, which breaks down starting wave 2 right here. Wave 2 corrects to the downside. Does not correct the entire distance of wave 1, but retraces most of it. Very typical wave 1 behavior. Wave 3 is long, but it is not an extension. Wave 5 will actually be an extension of this one. Wave 3, just a simple impulse wave. Breaks at the 61.8% mark of the original bottom. It says 38.2 since I measured it from the top, but 61.8, that represents the golden ratio. Breaks down, wave 4 right here, and then finally wave 5 of the primary cycle occurs right here. Wave 5 is extended. Wave 5 is extended into 9 subwaves once again, and it composes wave number 1. Wave 2 corrects, and these are intermediate waves. They're smaller. Wave 3 up again, wave 4 down, and then finally wave 5 is right here, brings us to the top. At this point, wave A begins. Wave A divides into 3 subwaves, composing of A, B, and C. Oh wait, no, A, B, C, oh, take that back, it's five subways to the downside, I'm sorry. Wave B is right here, counter trend move, retraces most of the initial downswing. And then wave C, which is normally the wave that does most of the damage, occurs right here. Wave C ends at about 1100, which is the top, just about the top of wave 1. So it does not retrace the entire distance of wave 1. So we're still staying within Elliott's rules. And this begins, well, let's just say this ABC right here. That is cycle wave 4 correction. And then wave 5 Roman numeral cycle starts right here. This gives us, let's see, wave 1 started in 2008. This gives us about, let's see, that took about a little over a year, this took a little over a year. This should give us at least another year before we have a large bear market. Like this Elliott wave analysis is showing us that we have another upswing that's going to happen in the market. So this pattern right here looks like it's going to be a leading diagonal. So likely it will move up, eventually break down to the downside, this pattern right here. Break down to the downside. It will retrace most but not all of this up move that we've seen. And then we will have a wave 5 classified by a lot of investor greed, fundamentals not improving that much, and then eventually sometime in 2012 and 2013 we should have another large bear market. Probably not as large as this, but certainly big. Okay, so that's Elliott wave analysis. If you have any questions, please ask. I'd be more than happy to answer them.